12 people meet in secret, and your mortgage changes. Your credit card rate shifts, your savings account withers, the currency in your pocket gains or loses value. Stock markets swing billions on their whispered words. Nations fall into recession or surge into boom cycles. All because a dozen individuals, whose names most people couldn't recall, gathered behind closed doors and decided what money should cost. Tonight, we explore one of the most powerful yet complex institutions in the modern world. Not a government you can vote out, not a corporation you can boycott, but a network of central bankers whose decisions ripple through every aspect of your financial life. The puppet masters. This is the story of how interest rates became the invisible hand that shapes nations, and how a system once designed to stabilize markets evolved into something that some critics argue has unintended consequences for ordinary people. The birth of modern banking. The story begins not in Washington, but in the counting houses of 19th century London. Some financial historians point to the Rothschild banking dynasty as an early example of how information networks could create market advantages that seemed almost supernatural to outside observers. On June 18, 1815, while Europe held its breath waiting for news from Waterloo, certain financial networks may have received information earlier than the general public. Napoleon had fallen. Wellington had won. But the market didn't know. Yet. According to some historical accounts, British government bonds began to be traded heavily during this period of uncertainty. Market participants reacted to rumors and partial information. When official news arrived hours later, significant price movements had already occurred, though the exact mechanisms remain a matter of historical debate. Some financial historians suggest this period demonstrated how information asymmetries could create market opportunities. They argue that those with faster communication networks gained systematic advantages, though the extent and nature of these advantages remains contested among researchers. Meanwhile, across the Atlantic, American financial institutions were developing their own approaches to banking and monetary policy. Some economists argue that these institutions were influenced by European models, but adapted them to American conditions and legal frameworks. The Panic of 1907 created significant challenges for the American financial system. As banks faced liquidity crises and depositors sought to withdraw funds, leading financiers met to discuss potential solutions. Different historians offer varying interpretations of these meetings and their ultimate impact on monetary policy. In November 1910, a group of financial leaders traveled to Jekyll Island, Georgia, for private discussions about banking reform. Some researchers view this gathering as an important step in the development of central banking in America, while others question the transparency of the process and its democratic implications. The Federal Reserve System. What emerged from these discussions became the Federal Reserve Act of 1913. Supporters presented it as protection against financial panics, though economists continued to debate its structure and effectiveness. Some critics have questioned whether the system optimally serves public interests, while others defend its stabilizing role. The structure was complex by design. 12 regional banks, nominally independent, but coordinated by a board of governors appointed by the president. Some economists argue this hybrid public-private structure creates potential conflicts of interest, while others contend it provides necessary expertise and independence. The 1920s provided an early test of Federal Reserve monetary policy. Interest rates were kept relatively low during much of the decade, which some economists believe contributed to increased speculation in stocks and real estate. Credit became widely available, allowing ordinary Americans to purchase consumer goods and invest in markets previously inaccessible to them. Then came October 1929. Economic historians note that the Federal Reserve had begun adjusting interest rates in the months before the crash, though they debate whether these policies were appropriately timed or scaled. The subsequent market collapse proved catastrophic for many investors and institutions. The aftermath revealed unequal impacts across different segments of society. While ordinary Americans faced unemployment and hardship, some investors with sufficient capital and information were able to acquire assets at significantly reduced prices. This pattern of crisis, creating both winners and losers, remains a subject of economic research and debate. Franklin Roosevelt's New Deal required substantial government borrowing to fund new programs. This debt was purchased by various financial institutions, creating new relationships between government and private finance. Some economists view this as necessary crisis response, while others question the long-term implications of increased government borrowing. The global expansion. World War II fundamentally reshaped global finance. At Bretton Woods in 1944, the victorious Allies designed a new international monetary system. The dollar became the world's primary reserve currency, backed by gold and supported by American economic strength. For the Federal Reserve, this represented a significant expansion of responsibilities and global influence. By the early 1970s, this system faced mounting pressures. Facing inflation from Vietnam War spending and domestic programs, President Nixon ended the dollar's convertibility to gold in 1971. This decision, known as the Nixon shock, moved the global economy toward a fully fiat monetary system. Economists continue to debate the long-term implications of this transition. The 1970s brought inflation, unemployment, and economic uncertainty. In 1979, Federal Reserve Chairman Paul Volcker implemented dramatically higher interest rates to combat inflation. The immediate consequences were severe: recession, unemployment, and business failures. However, some economists argue this shock therapy was necessary to restore price stability. These high interest rates had broader effects on the economy. They attracted international capital to American financial markets and contributed to the growth of the financial services sector. Some economists note that during this period, finance began to play a larger role in the American economy relative to manufacturing and other sectors. When markets crashed in October 1987, Federal Reserve Chairman Alan Greenspan responded with increased liquidity provision. This intervention helped stabilize markets quickly, though some economists later questioned whether such interventions might create moral hazard by encouraging excessive risk-taking among market participants. Throughout the 1990s, the Federal Reserve faced decisions about how to respond to rapidly rising asset prices, particularly in technology stocks. Some economists argued for more aggressive intervention to prevent bubbles, while others contended that monetary policy was not well suited to address asset price inflation directly. When the dot-com bubble collapsed in 2000, the Federal Reserve responded with significant interest rate reductions. While this policy may have helped cushion the recession, some economists later argued that sustained low rates contributed to increased risk-taking in housing markets during the following 2001 decade. The 2008 crisis response. The 2008 financial crisis posed unprecedented challenges for monetary policy. When major financial institutions faced potential insolvency, policymakers had to balance competing concerns about moral hazard, systemic stability, and economic recovery. The Federal Reserve's response included both traditional and unconventional monetary policy tools. Quantitative easing represented a significant policy innovation. The Federal Reserve purchased large quantities of government bonds and mortgage-backed securities, expanding its balance sheet dramatically. Supporters argued this was necessary to restore market function and support economic recovery, while critics raised questions about potential longer-term consequences. Each summer, central bankers from around the world gather in Jackson Hole, Wyoming, for an economic symposium sponsored by the Kansas City Federal Reserve. The conference provides a forum for discussing monetary policy challenges and sharing research, though some observers note that significant policy coordination may also occur through informal channels. The COVID-19 pandemic created economic disruptions that required rapid policy responses. The Federal Reserve implemented unprecedented monetary accommodation, including zero interest rates and unlimited bond purchasing commitments. Economists continue to evaluate the effectiveness and potential side effects of these interventions. These monetary policies had wide-ranging effects on asset prices. Housing costs increased significantly in many markets, while stock prices reached historically high levels relative to traditional valuation metrics. Some economists argue these outcomes reflect necessary market adjustments, while others express concern about affordability and financial stability implications. Modern monetary policy. Today, the Federal Open Market Committee meets 8 times per year to discuss monetary policy. 12 voting members review economic data, financial conditions, and policy options. Their deliberations follow established procedures, with transcripts released after 5-year delays, a practice some transparency advocates question, while others defend as necessary for candid policy discussions. Central banks coordinate policies through institutions like the Bank for International Settlements in Basel, Switzerland. This coordination helps address global financial challenges, though some economists debate whether such coordination adequately represents diverse national interests and democratic input. Interest rate determination involves complex economic modeling and data analysis. However, recent market disruptions have raised questions about how effectively these models capture real-world dynamics. Some researchers argue for greater transparency in decision-making processes, while others emphasize the need for technical expertise in monetary policy. Today's financial markets operate with unprecedented speed and complexity. Computer algorithms execute millions of transactions based on monetary policy announcements and economic data releases. Some market observers question whether this technological evolution has improved or complicated price discovery mechanisms. Central bank digital currencies represent a potential evolution in monetary systems. Proponents argue they could improve financial inclusion and payment efficiency, while critics raise questions about privacy and government oversight capabilities. The development of these technologies remains an active area of policy research and public debate. So who really controls interest rates? The formal answer is straightforward. The Federal Open Market Committee, operating under congressional mandate to promote stable prices and full employment. But economists offer varying perspectives on how well this system serves different groups in society. Some argue that central bank independence is essential for effective monetary policy, while others question whether current arrangements adequately balance technical expertise with democratic accountability. The debate over monetary policy reflects broader questions about expertise, representation, and economic outcomes. Some researchers emphasize the complexity of modern economies and the need for specialized institutional knowledge. Others argue for greater transparency and public participation in economic policy decisions. Understanding these systems requires examining both their technical operation and their social consequences. Different groups experience monetary policy effects differently, and these differential impacts remain an important subject of economic research and policy debate. The questions surrounding monetary policy, who makes decisions, how they're made, and who benefits, reflect ongoing tensions in democratic societies between expertise and representation, efficiency and equity. As our financial systems continue to evolve, these questions may become more important, not less.